IVW's 4-point lead looks great now, but VUG's lower fees quietly win the decades-long marathon ahead. That small fee difference compounds ruthlessly over decades, quietly eating tens of thousands from your future returns. Soon IVW's pulling ahead with 99% returns over 5 years, beating VUG's 93% by a solid 6 points. That IVW edged ahead over 5 years, but here's what matters. They're practically neck and neck like race cars, with nearly identical engines under the hood. While IVW edges ahead on risk-adjusted returns, generating slightly better bang for your buck per unit of volatility taken. Both funds nail identical 0.8 Sortino ratios. They're rewarding you equally well for handling the downside risks here. Think of these as report cards for efficiency. IVW edges ahead overall, but they're equally matched when protecting your downside during market drops. These funds swing nearly identically. Just 1 percentage point separates them. Volatility won't help you pick a winner here. Same drops, same climbs. Both funds are identical roller coasters. You're getting the exact same turbulence either way, so don't expect a smoother ride here. The IVW held up better during crashes, dropping 33% versus VUG's 36%. That 3-point cushion matters when markets tank. VUG bounced back nearly 2 months faster, recovering in 446 days, versus IVW's 504 days after their worst crashes. Here's the swimming pool analogy. IVW doesn't drop quite as far, but VUG recovers faster once the market turns back around. VUG costs just $4 per 10,000 invested, less than a quarter of IVW's $18 fee. That 0.14% fee gap sounds tiny, but it'll quietly compound against you over 35 years of investing. Expense ratios are like couch change slowly vanishing each year. VUG's pennies add up way less painfully than IVW's nickels over decades. That IVW holds 217 stocks versus VUG's 163. Broader diversification means you're spreading risk across 54 more companies here. IVW edges ahead with a 99% 5-year return and better Sharpe ratio, though VUG's lower expense ratio matters. Both survive similar crashes beautifully. Both funds are basically tech plays here. 51% VUG, 49% IVW. Nearly identical tech exposure means similar sector risks. Both funds load half their eggs into one basket. Technology? That's concentration risk, not diversification. If tech stumbles, your portfolio tumbles right alongside it. IVW reshuffles a third of its portfolio yearly, while VUG barely touches its holdings, 7 times less trading activity. VUG costs nearly $3 more per earnings dollar. You're paying a premium of almost 10% here. Think of it like finding couch change. VUG charges more coins for the same earnings power, making IVW your relative bargain here. IVW wins short-term with better returns, but VUG's lower fees make it the smarter pick for long-term investors. So which fund fits you? IVW works for moderate timelines, while VUG's built for long-term compound growth. IVW might be ahead now, but VUG's lower costs compound over time. Like marathon runners, the young benefit most from conserving energy over decades. Standard disclaimer: do your homework, consult professionals, and invest at your own risk here. Hit that subscribe button for weekly data-driven ETF breakdowns that show you which funds actually deliver results.